In this video, I am gonna show you guys how to pick your first stock in under 3 minutes, because you know what? The stock market is not as complicated as people make it out to be. In fact, picking stocks is extremely simple and easy if you follow my strategy, and more importantly, if you have the right mindset. So let's get into it. The very first thing you want to do is click that like button, subscribe, and then smash that bell notification so you never miss another video. And now with that out of the way, let's get back to the video. Okay, so the first thing you want to do when looking for your very first stock is look at companies that are in an industry that you understand. For example, let's say you understand the gaming industry. You can choose to invest in a company like Activision Blizzard. You can also go with Take-Two Interactive Software, Electronic Arts, Ubisoft, etc. My point is that you want to look for companies that you're familiar with, because investing in something that you do know is just too risky in my opinion, especially if you're a beginner. The next thing you want to do is open up Google and type in the name of the company that you chose, followed by buy or sell, and see what comes up. As you can see, there are two things going on here. We have buy ratings from Wall Street analysts, and we also have sell ratings from Wall Street analysts as well, but we're not interested in those. We're only interested in these buy ratings over here. How many are there? Well, let's count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So there are 12 buy ratings, with 11 being in the last 3 months. Now before you go ahead and invest in this company, you need to ask yourself whether or not they're a good investment. And the best way to find out is to look at their most recent quarterly earnings report. To do that, all you need to do is type in the name of the company, followed by quarterly earnings, and then click on this one here. This is their most recent quarterly earnings report. So I'll click on this link over here. And this is what every company that's publicly traded has to release every single quarter. What's interesting about quarterly earnings reports is that they always get released after hours. So if you want to see the future of a company, you want to look at their quarterly earnings report as soon as it releases, because that's when the stock price will react. I personally like to look at earnings reports around 4 p.m. Eastern Standard Time, because that's usually when they release them. If you see a bunch of buy ratings, but the stock price is falling down, that's usually a sign that you have found a potential diamond in the rough. Just remember though, the stock market is not a casino. You shouldn't be gambling your money. You should only be investing in companies that you believe in long term. Okay, so let's take a look at Activision Blizzard's quarterly earnings report. They've got $78 million in cash and cash equivalents. They've got $6.6 billion in total assets, and they're sitting on a war chest of $9.3 billion in net cash. Now I don't know about you, but I would love to sit on a $9.3 billion cash pile. That's a lot of money. Not to mention, they made $2.27 billion in revenue during the last quarter. Next, we want to see if the company is making a profit. How do we do that? Well, we scroll all the way to the bottom and we look at their GAAP net income. It says right here, they made $430 million in net income. Not to mention, they beat estimates by 5 cents. This means that they were able to execute and deliver on what they said they were gonna do, which is a great sign. If you want to learn more about how to read quarterly earnings reports, I'll leave a link down below in the description area for you guys to check out. But if we scroll further down, we can see that they have zero long-term debt. Zero. Imagine having $9.3 billion in cash and no debt. It doesn't get any better than that. Now some of you might be thinking, okay, so the company is doing good, but how is this benefiting me as a shareholder? Well, if we go to the very last page of their quarterly earnings report, we can see the diluted earnings per share was 97 cents. And if we go to the bottom, we can see that they paid out a dividend of 84 cents, and that was 4.5% of their revenue. And then if we go to the bottom, we can see that they actually increased their dividend by 10%. Remember, they have $9.3 billion in net cash, zero debt, and they're paying out a dividend of 4.5% of their revenue. Plus, the stock currently has a 3.27% dividend yield, which is absolutely absurd. Like you could just sit on your butt and collect dividend checks from this company for years to come. Not to mention that they're buying back their own stock. They spent $537 million buying back their own shares. And lastly, they also spent $428 million on property and equipment for the quarter. I want you to keep in mind that investing is not just about making a ton of money. Sure, that would be nice, but it's also about keeping your money safe. And if you look at their balance sheet, they have a strong balance sheet because they have $9.3 billion in cash and zero debt. There are not many companies out there who can say that they have zero debt. Most companies have billions of dollars in debt, and that debt can be dangerous. It can lead to bankruptcy if they don't have enough cash to pay it off. But Activision Blizzard is in a great financial position, so I'd feel comfortable investing in this company. You also want to consider market cap. Market cap is simply the amount of shares outstanding times the current price of the stock. For example, if I had 100 shares of Apple at $100 per share, my market cap would be $10,000. Now, obviously, I don't have $10,000 worth of Apple, but that's just an example. The reason why I bring up market cap is because I think Activision Blizzard is fairly valued. Their price-to-earnings ratio is 22.71, and that's not bad, considering that the average price-to-earnings ratio for the S&P 500 is 33. So I think they re-undervalued. Plus, their forward price-to-earnings ratio is 16.28, meaning that the market is expecting lower earnings from this company in the future, and that could be a good thing if the company beats their expectations. So, I think this is a great buying opportunity. If you're a beginner investor, I highly suggest that you look for companies that have a price-to-earnings ratio under 20, because that's usually a good indication that the stock is undervalued. Now, some of you might be saying, okay, Brandon, I understand the company's fundamentals, but how do I know if they've re-gone? Nah, go up tomorrow, or next week, or next month. Unfortunately, you can't know for sure. No one can tell you that. The stock market is unpredictable. Anything can happen. But if you look at their revenue and compare it to previous quarters, you can see that it's been fairly consistent. So I don't expect any major red flags in the near future. Of course, anything can happen. But I'm just looking at the data and the numbers. So if I were you, I would wait for a dip in the stock price and then buy in slowly. You could buy 25% of your shares, then wait for another dip, and then buy another 25%. Then wait for another dip and buy another 25%, and then finally, buy the last 25%. This is called dollar cost averaging, and it's a great way to invest your money. It helps you reduce risk, and it helps you take advantage of market volatility. If you want to know where I get all of my data from, I'll leave a link down below in the description area. It's completely free, and I highly suggest you guys go check it out. Now, please remember that I'm not a registered financial advisor. This is not financial advice. You should always do your own research, and you should always invest in companies that you believe in long term. With that being said, thank you guys so much for watching. I hope you have a profitable day.